Hey, what's up, everyone? My name is Ale. Welcome back to my world of stocks. Today, we've got another episode of big stock purchases made by famously large investors. Except this time, not only are we taking a look at the second largest asset management company in the entire world in the Vanguard group, which literally holds trillions of dollars in the market with giant influence over it. But to make it a little more fun and interesting, I specifically pulled out three of the largest, most controversial of those purchases that they made last quarter, which just got released to the public through their SEC filings. And so these are three very polarizing type of stocks that some people may actually love investing in, while others may really dislike the company and their practices, considering the stocks uninvestable. So it's going to be super interesting to look at. I can't wait to share these with you. And just a heads up, I do promise to be as unbiased and neutral as possible when looking at these names. However, I will still share with you my general thoughts and opinions on these stocks and let you know if I plan to buy any of them myself too, and why or why not. So smash that like button if you like these more kind of obscure types of videos once in a while. I think it's a fun idea to try out. So I hope you enjoy the video, but let's go ahead and jump straight into the list here. Now we'll be sorting these from smallest to largest purchase last quarter. And coming in at number one, the smallest of the bunch, well, we have none other than the tobacco giant Philip Morris International, ticker symbol PM, which Vanguard added another 166 million more dollars of in the quarter, which is an estimation based on the amount of shares purchased during the period. And that's now brought their total stake in the company up to more than $22 billion worth in the portfolio. Now, why is PM considered controversial? Well, it's obviously one of the biggest cigarette companies out there, with their international Marlboro brand being likely the most recognized in the space, with the company as a whole also claiming the second most market share in the entire world, only second to China National Tobacco Corporation. And although that part of their business has been in heavy decline, the company still sells well over 600 billion cigarettes per year. Of course, the reason why this makes them controversial is because smoking has been linked to over 8 million deaths per year, according to the World Health Organization, with more than 1 million of them just being caused by secondhand smoke alone. In fact, it can be so controversial that many ESG and socially conscious funds won't even invest in companies like Philip Morris that are often considered a quote sin stock. However, bulls, on the other hand, would argue that the company has made huge strides in moving away from smoking products, investing heavily in smoke-free alternatives like IQOS heated tobacco devices and ZYN nicotine pouches, both of which continue to see large growth. In fact, the moves have been so successful for them that PM was able to crush last quarter's earnings expectations on both the top and bottom line, while also raising their full year guidance. It also marked double-digit organic growth on both sales and profits, with their smoke-free segment growing by even more, posting 20% and 33% growth on sales and profits respectively, while combustibles only posted a mid-single-digit growth rate on each instead. But because of this, their smoke-free segment has already grown to, get this guys, nearly 40% of the company's entire business, which they aim to be more than 2/3 of their sales by 2030. Now, to be clear, that doesn't mean that these new products aren't also bad for your health in their own ways, which happens to also be a topic of contention these days, with many arguing both sides of that debate. However, to me, that too is just another example of how controversial a company like this can be, selling these types of consumer ingested products that so many people have strong feelings on, either positive or negative. Which, to be fair to Philip Morris, heart disease is also widely known for being one of the biggest causes of death in the world, yet companies like McDonald's, Coca-Cola, and PepsiCo don't get nearly as much backlash as Philip Morris does. But as the old adage goes, two wrongs don't make a right. So just because other companies get away with it doesn't mean that Philip Morris will get away with it too. And as an investor myself, not in this talk, but as an investor in general, even if I just put any of my, let's say, personal ethics or morals aside, I still believe that the fewest amount of controversies surrounding a company is what's best for business, which is why I don't usually invest in the so-called sin stocks. But even if I just ignore that part of it too, as someone who's never used any of PM's products myself, this would still be a tough stock to invest in regardless, because I'd have a hard time keeping track of the market, the products that they sell, their competitors, or even just getting excited about future product releases when I know so little about them. But I can understand why others choose to own a stock like this, as the company is clearly performing very well right now and is still finding new ways to grow sales every year despite the stigma surrounding cigarettes, with profits also expected to rise in the coming years, and it even pays out a nice dividend too, about above 3%. I will just caution you though that the stock has skyrocketed recently, leaving their PE ratio significantly higher than the sector, with also most analysts having price targets that are now well below where the stock currently trades today. And the dividend yield has also fallen to one of its actually lowest levels that we've ever seen. You know, in the past, most investors owned this stock for having a super cheap valuation and a sky high dividend of around 4, 5, or even 6%. But today, after the run up in stock price, it's just much less attractive than it used to be. And for me personally, there's just so many other value dividend stocks out there that I'd much rather own myself, because they not only have higher yields, but also far less controversies, which again, I just think is bad for business. But let's see what else we got on this list. Maybe I'll change my mind on one of these other ones. Okay, moving on to controversial purchase number 2. We have another super interesting pickup here. This time in the healthcare behemoth known as United Health Group, ticker symbol UNH, which Vanguard added another $440 million of in the quarter, bringing their stake up to over $37 billion worth. Now, when looking at United, it may not seem like a typical controversial stock in the sense that, they aren't really selling any kind of harmful product or service like a typical sin stock would. However, this one, excuse me, this one can still be just as polarizing as any other company out there. And that's because they're the world's largest health insurance provider, serving over 50 million people. And as such, they're typically one of the first to get called out for our broken healthcare system, being accused of caring much more about profits than they do about their own customers and patients. In fact, United themselves have been accused by Forbes and other publications too for denying more claims than almost any other private insurer in the market, which in turn is believed to be at least part of the reason why their subsidiary United Healthcare's CEO was tragically unalived at the end of last year, which I can't even discuss with you much further because of how shockingly terrible the incident really was, that I would likely get demonetized here on YouTube even just for talking about it. And as if all of that wasn't enough to scare investors away from the stock, just this week it was revealed that the DOJ is actually investigating United for Medicare fraud too, which sent the stock crashing by over 18% at one point. But putting all the controversies aside for a moment, the business itself has always been incredibly strong, with sales, for example, reaching an astounding record high of more than $400 billion last year, and yet is still growing by around a high single-digit to double-digit rate expected in the coming years too. And profits have been just as impressive, generating a new record high of more than $33 billion last year. Now, obviously, that's pretty weak margins, considering, if you compare it to the monumental sales that they generate, but that's because insurance businesses typically operate on high volume and low margin because of all the claims they have to pay out. Hence why they're typically so stingy about having to actually pay out any of those claims because of how much it directly affects their margins. But in the case of United, again, doing the massive sales that they do. I mean, you're talking giant volume, more than 400 billion in sales, and then you're still doing more than $33 billion in profits per year. That's a giant amount, regardless, that most other companies in the world can't even dream of ever reaching. And looking out into the future, United even has a couple growth catalysts to look forward to as well, like the giant and aging baby boomer population that will soon see every boomer hitting at least 65 years of age by 2030, resulting in 1 out of every 5 US citizens being of retirement age, which should increase the demand for healthcare more than ever before. Plus, on the more kind of technological side of things, United's investments into their Optum division that focuses on care, services, data, and other related tech should be another source for growth over time, especially with its work in artificial intelligence that is not only opening new revenue streams for the company, but is even helping them run more efficiently and profitable too. And best of all, is that this entire package comes at one of the lowest valuations that we've ever seen from them, after the stock has now lost over half of its entire value from the top, leaving it actually negative in the past 5 years, despite this normally being a very strong performing stock. I mean, it's insanely rare that we would ever see it fall like this. And the PE ratio is now also trading around 40% lower than both their 5-year average and the sector median, while their dividend yield has also risen above 3%, which is the highest level that I think I've ever seen from them. I don't think it's ever reached that high, because usually the stock price is higher and the dividend is lower. Despite all these bullish reasons to buy the stock, though, which I think are very attractive just from an investment standpoint, there are still a couple reasons why I don't own this stock myself. Number one is that the business doesn't really interest me that much. Never been super excited or interested in learning more about healthcare or keeping track of it. Number two is that all the controversies are really going to be a pain to keep track of in itself, especially the new DOJ investigation that we currently have like very little information on. So it's hard to give an opinion on until we see how that plays out. And then number three is that just like Philip Morris, I just feel that there are so many better value dividend stocks out there with higher yields and much less controversy to deal with. So if I really wanted a dividend stock, I think I'd look elsewhere. Anyway, even if I put like all of my, again, moral or ethical feelings aside, I do think that it's more attractive of a stock from an investing perspective than Philip Morris. But it's still not a stock that I would say I'm personally interested in myself. I can understand why others are choosing to buy it right now, and I've been hearing from people that they're buying it on this dip, but it's not really the right fit for me personally. Okay, now while I don't own either of those first two stocks, purchase number 3 was a little surprising. It's actually a stock that I currently own myself. So maybe you can pause the video and take a guess at what that stock might be. Leave a comment down below, see if you can guess what it is. But coming in here at purchase number 3, spoiler alert, I'm going to say it now. It was, of course, the EV giant Tesla, ticker symbol TSLA, which Vanguard added another $1.2 billion of in the quarter, bringing their stake up now to almost $64 billion worth in total. Now for Tesla, though, when it comes to their controversies, it's a bit of a weird case because, the company and really the CEO, Elon Musk, they were always really loved by their core kind of liberal fan base that cares a lot about things like the environment, climate change, and all those sort of, more kind of left-leaning types of things that Tesla, as the largest EV seller in the world, was really known for championing. However, during the last election cycle, Musk really shocked that core fan base by putting 100% of his support fully into the one man that Democrats probably hate more than anyone in the world right now, in Donald Trump. And so, as you would expect, they've now been boycotting and protesting the brand very strongly, while on the flip side, conservatives and like Republicans now tend to view Elon Musk as sort of like their hero and would probably be much more open to buying a Tesla vehicle now than they ever were in the past. Now, before we go any further, just know that I don't ever preach to you guys about politics, and this video will be no different. I only ever evaluate stocks like Tesla from a business and investment perspective alone. Not interested in all the politics and all that and alienating, half of my audience. But unfortunately, for any Tesla shareholders, anytime that a company does upset their core fan base, like has been in this case, it is likely going to result in much less demand for their products, which in the case of Tesla, they were already dealing with falling revenue growth as competition has been heating up too. In fact, despite the EV market continuing to grow, Tesla saw their revenues fall almost flat last year, which is also expected to happen again this year too, while their EPS crashed by over 50% last year as well. Now, the good news though is that these numbers are expected to heavily rebound in the coming years on optimism surrounding their upcoming cheaper mass market vehicle, the expansion of their energy business, which continues to grow much stronger, the rollout of a high growth and high margin robo-taxi service that I think is actually a lot easier for them to launch and control and manage. And I think they could be one of the best at it than maybe people realize. And then also like the eventual release of even a fully fledged robot that I think could actually see higher demand than people might realize too, because of how much they could be used in factory work and for other businesses and stuff like that. But the issue that I have with Tesla stock at the moment is that it just continues to be at a very rich valuation, because even after dipping around 30% from the top, and it's recovered a bit since then, but their forward PE ratio still sits north of 130, which is extremely high. And even by 2027, where analysts are expecting them to generate record-breaking sales and profits, that PE would only fall to still above 80. And so at these levels, and with all the controversies that can directly impact their business, I may not consider Tesla stock to be a clear buy like I have in the past, but I also don't really plan on selling any of my shares either for two specific reasons. Number one, I just think that the markets that they operate in have so much future potential that I don't really want to risk being left out of that opportunity. And not just with EVs, but also autonomous driving, robo-taxis, energy, battery storage, robotics, AI, and even logistics with the new Semi 2. I think there's a lot of things they could do there that would surprise people. But number two is also that unlike the other stocks that we've looked at today, Tesla is the only one of the three that I think the controversies could potentially help in at least some small way to offset at least some of the damage that it's been done. And that would be through regulation, which is easily one of the biggest obstacles in the way of autonomous driving, robotics, and more. So having a very close relationship with a president, right? Like ignoring which president it is for a moment. Just the fact that you have a close relationship with the president of the United States, who, by the way, literally ran his campaign on deregulation. So it's something that he's kind of known for. Well, that may ultimately end up helping Elon Musk get some of his businesses over the finish line, now being friends with that person. I get that a lot of people, might not like that person, but I'm just saying that there is a possibility that that could help him in some ways. Not to mention that tariffs, by the way, could also help shelter Tesla from cheaper Chinese competition, which is something that Tesla has always argued before. Elon Musk even said this before the Trump presidency, that he wanted tariffs on Chinese cars. And Tesla, the reason why they might actually want some of that is because they're better insulated than really any other automakers because of their localized sourcing and production in places like North America, Europe, and even China. But again, at present time, I just see too many controversies and risk really to call this stock like a clear buy. I think it's more of a hold at the moment, and I'm up a lot on my position, so it's easy for me to hold it. But I know that many of you, might think that it's a sell or might not want to own it. But hey, let me know down in the comment section. How do you feel about it? I respect all views. I'm just here to show you some controversial stocks that Vanguard is buying and give you my opinion on them. So anyway, those are my thoughts and opinions. I'd love to hear what you think. Let me know if you agree or disagree with anything I said today. I'd love to hear your thoughts. And either way, I hope that you enjoyed the video. I hope you had some fun. And I thank you so much for your support. It really means a lot to me. And I will catch you in the next video, my friends. All right, take care, everybody. Hope you're all doing well. Bye-bye.